1. Introduction to Life Insurance Module. It has often been said that the only certainties in life are death and taxes. It could be argued that some people will not have to pay income taxes because they have little or no taxable income, or because they manage to structure their financial affairs to avoid them. However, there is no denying that everyone is going to die sometime, and death has implications for their estate and surviving family members. This chapter provides an introduction to the risk of death and its financial implications. It also discusses general risk management strategies as they apply to the risk of death. 1.1 Risk of Death. One of the reasons people delay buying life insurance is that they do not want to think about their own death. They either refuse to consider it at all, or they say that it is too far away in the future to worry about today. But the fact is that everyone is constantly exposed to the risk of death every day, every minute, every second. The probability of dying today might be much smaller than it will be 40 years from now, but the risk is still very real, and it needs to be addressed. In insurance terms, the probability of dying at a specific age is referred to as the mortality rate. There are many factors that influence a person's risk of death, including age, gender, family history, health, smoking status, and even their job and income level. Life insurance companies try to classify or categorize people into groups with a similar risk profile. They then compile historical mortality data for each group, and use that as a basis for estimating an individual's risk of death. This is discussed further in Chapter 9, Application and Underwriting. There are two ways of looking at the risk of death: life expectancy and probability of death. Life expectancy is the average number of years that a person within a certain group and of a certain age can expect to live from that age forward. It assumes that the past mortality experience of the group to which that person belongs will hold true in the future. For example, according to data compiled by Statistics Canada, if we consider all males in Canada who are age 65, the median male within that group will live another 19.5 years. 1 This means that on average, 50% of men currently age 65 will live until age 84.5 or longer, while 50% will die before reaching age 84.5. The probability of death is the statistical probability that a person within a certain group and of a certain age will die before reaching his next birthday. It assumes that the past mortality experience of the group to which that person belongs will hold true in the future. The same Statistics Canada study shows that of all of the males in Canada who just turned 65 years of age, 1.103 out of every 100 of those men will die before their 66th birthday. 2 In other words, their probability of death is 1.103%. Chapter 9 discusses how insurance companies use this probability of death when they underwrite a life insurance policy and determine the appropriate premiums. Life expectancy and probability of death statistics are compiled for each unique and defined group of people, and are often presented in a format called a life table, sometimes also known as a mortality table. An extract from a Statistics Canada life table is provided in Table 1.1. With the exception of the first few years of life, an individual's probability of death starts quite low and increases very slowly until around age 40. After age 40, it begins to increase more dramatically year over year due to age-related health problems, such as cardiovascular disease. This table shows that a female's risk of death is lower than a male's risk of death at the same age. For this reason, gender is one of the factors that influence an individual's life insurance premiums, as discussed in Chapter 9. The way an agent uses this information depends on the specific needs he is trying to address. If he is developing a retirement savings plan or retirement income plan, the focus would be on the client's life expectancy because it helps determine the appropriate planning horizon. When doing insurance needs analysis, the agent may find it useful to educate a client on his probability of death, to help him understand that the risk is real, and that he needs to address it. 1.2 Potential financial impact of death. Death is a tragedy, whether it is the loss of a spouse, a child, a friend, or a key employee. That tragedy is magnified by the financial consequences of that death. This section introduces the types of financial impacts that an agent would be thinking about when he explores the risk of death with a client. It does not cover all possible financial impacts, but is simply meant to provide some context before discussing the various types of life insurance. Chapter 10, Assessing the Client's Situation, provides a more detailed explanation of the financial impacts that an agent should quantify when completing a life insurance needs analysis for a client. 1.2.1 Loss of income. One of the most devastating financial impacts results from the death of an income earner, particularly if he was supporting a young family that relied on that income. Example: Justin and Tanya are both 30 years old, and they have 3 children, 1, 3, and 4 years old. Tanya currently stays at home with the children, so Justin is the sole income earner. How would this young family cope financially if Justin died? The loss of Justin's income would be devastating. 1.2.2 Loss of caregiver. Even the death of a non-income earner can have a significant impact on the surviving family's finances, particularly if the deceased took care of the family's children or other dependent family members. Life Insurance Chapter 1, Introduction to Life Insurance, Module 4. Example: Kant. Now consider what would happen if Tanya was the one who died. As the sole income earner, Justin would not be able to afford to stop working to care for the children. Unless another person could step in and assume the role of caregiver to the children free of charge, such as one of Justin's or Tanya's parents, Justin would have to hire someone to assume this role. 1.2.3 Debt repayment. When a person dies, one of the first responsibilities of the executor of the estate is to pay off any outstanding debts, including mortgages, car loans, and credit card debt. In some cases, the lender may be willing to extend the loan to the surviving spouse or another beneficiary who inherits the property that is encumbered by the debt, but usually only after ensuring that this person has the income needed to make the loan payments. If the lender decides that the risk of default is too high, it will recall the loan, demanding payment in full. Example: Kant. If Justin dies, the bank is unlikely to extend the mortgage to Tanya because she is not working. She would have to sell the family home to pay off the debt. 1.2.4 Income taxes. The income tax liability that arises upon death can seriously erode an estate. When a person dies, he is usually deemed to have sold all of his property for its fair market value, unless a rollover applies, which can trigger a taxable capital gain. If the estate does not have enough money to pay the resulting income tax, the executor may have to sell assets that were intended to be left to the beneficiaries. Example: Arnold bought a cottage in 1980, and he left the cottage to his daughter, Linda, in his will. When he died in 2021, the tax liability on the cottage amounted to $80,000. If the estate does not have enough money to pay this income tax, the executor would have to sell the cottage to pay the tax, or Linda would have to pay the tax personally. When a person dies, his registered assets, example, Registered Retirement Savings Plan, RRSP, Registered Retirement Income Fund, RRIF, will also be deregistered, unless a rollover applies, which means the full amount will be taxed at his marginal tax rate at death, which could easily be in the top tax bracket, which ranges from a low of 44.5% Nunavut to 54% Nova Scotia, depending on the province. 1.2.5 Estate creation. When contemplating their future death, clients often reflect that they want to leave something behind, to have something to show for their life. For people who are just starting out in their adult life, with little or no net worth, leaving behind an estate can seem impossible. Some common estate objectives are discussed below. 1.2.5.1 Education funds. A person with children might say that he wants to make sure that his children can go to university or college, even if he dies. Example: Kant. Justin and Tanya feel it is important to pay for their children's education. Depending on the educational program and its location, they estimate this could cost $20,000 per year, per child, or about $240,000 for a 4-year program for all 3 children. 1.2.5.2 Legacies. A person might also want to make a financial gift to someone special upon death, perhaps in appreciation of that person's past service or support, or to help someone get a start in life. Example, Kant. Tanya received a lump sum bequest of $100,000 when her father died, and they used it as the down payment to buy a house. They would like to be able to leave a similar legacy to their children if they should die, to help them buy their first house or start a business. 1.2.5.3 Charitable Giving. Many people would like to remember their favorite charity upon their death, and perhaps support them in a way they were not financially able to during their lifetime. Some people also make donations for the tax benefits, which will be discussed in Chapter 7. Life Insurance Chapter 1 Introduction to Life Insurance Module 6. Example, Kant. Justin had a difficult time growing up, and he spent a year living on the streets before he entered a youth support program that completely turned his life around. He credits that program with helping him achieve the satisfying life he leads today, and he would very much like to support the program with a significant cash donation when his finances permit, or upon death. 1.2.6 Business Impacts. The death of a key employee or shareholder can have a devastating impact on a business, sometimes even resulting in its collapse. See section Key Person Life Insurance. Example. Alan owned a thriving boutique restaurant called Vertical. Some of its success was due to its amazing location, quirky interior decorating and personable staff, but the real draw was Vertical's chef, Luigi. Customers raved over Luigi's signature dishes and his tableside manner. He always visited each table personally to say hello, and to make sure each meal was to the customer's satisfaction. When Luigi died suddenly, the restaurant's revenue dropped dramatically. It took Alan almost 6 months to find a chef of the same caliber, and then Alan had to launch an expensive marketing campaign to lure customers back to the restaurant. The financial strain during this time came very close to bankrupting Alan. 1.3 Risk Management Strategies. Regardless of the type of risk, there are 4 general strategies that should be considered to deal with that risk. Black small square risk avoidance. Black small square risk reduction. Black small square risk retention. Black small square risk transfer. The strategies can be used alone or in combination. The agent and his client will need to decide which strategies are most appropriate to deal with the client's risk of death. 1.3.1 Risk Avoidance. The first risk management strategy is risk avoidance, which is simply deciding not to expose oneself to the risk in the first place. For example, a person could avoid the risk of having a car accident by choosing to not drive a car, perhaps relying on public transit instead. Unfortunately, it is impossible to avoid the risk of death. Simply by the act of living, everyone is exposed to the risk of death. Therefore, other strategies are needed to address the risk of death. 1.3.2 Risk Reduction. If it is not possible to avoid a risk entirely, it may be possible to take action to reduce the probability or severity of that risk. This is called risk reduction. Consider the person who has to drive a car because it is his only option for getting to work. He can reduce his risk of having a car accident by obeying traffic rules, making sure the car's brakes and tires are in good condition, or taking lessons in defensive driving. Similarly, a person can reduce his risk of death by maintaining a healthy lifestyle and avoiding hazardous activities. However, this will not completely eliminate the risk of death. It will just reduce the probability of a premature death. Therefore, additional strategies are needed to deal with the remaining risk of death. 1.3.3 Risk Retention. The third option or strategy is risk retention, which means that the person accepts the fact that he is exposed to the risk, and will accept the consequences if that risk is realized. Risk retention is most appropriate for risks of low severity, meaning risks with a manageable financial impact. For example, consider a person who buys a new appliance and who has the option of buying an extended warranty. He can pay for the extended warranty, and he will be protected if the appliance breaks during the extended warranty period. He can also refuse the extended warranty and retain the risk that, if the appliance breaks after the original warranty period expires, he will have to pay for the repairs or a replacement. The risk of death is usually considered to be a high-severity risk because of the significant financial impact it can have. Most clients will not have sufficient financial resources to be able to manage the financial impact of death, so they need another strategy to deal with this risk. 1.3 for risk transfer. The final risk management strategy is risk transfer, which means finding someone else who is willing to assume the consequences if the risk is realized. Insurance is a risk transfer strategy. To deal with the risk of death, a person can trade the possibility of financial catastrophe, if death occurs now, for the certainty of paying annual insurance premiums. Insurance is sometimes also referred to as risk sharing, because it shares or spreads the losses of the few amongst the many. In other words, it shares the financial losses of those few people who experience the insured event with all of those who buy insurance to protect themselves against that event. James and Mary are married. They are both concerned about having a car accident and the possibility of dying as a result. James adopts a risk avoidance strategy by choosing to take public transit instead of driving to work. Mary understands the risk of driving. By deciding to keep driving to work, she adopts a risk retention strategy. She also adopts risk reduction strategies by choosing a car with a high safety rating and wearing her seatbelt and obeying all traffic rules when driving. Mary is aware of the financial impacts that could result from a car accident, so she purchased automobile insurance 5 and life insurance. This is a risk transfer strategy because if she does have a car accident, the insurance company assumes the financial liability. Chapter 2, Term Life Insurance. Competency component black small square analyze the available products that meet the client's needs. Competency subcomponent black small square analyze the types of contracts that meet the client's needs. Life Insurance Chapter 2 Term Life Insurance 10.